Was the closing bell. Welcome to the closing bell as well. I'm David Faber, in for Wilford Frost, and of course I'm here along with Sarah Eisen and Mike Santoli, CNBC's senior markets commentator. Sarah just mentioned, let's take a look at how we closed here.
We do this again at the top of the hour.
Yeah, I know. You just did it. We do it again. All right. Well, things can change ever so slightly. As you see, the Dow was down by almost 200 points there. S&P and NASDAQ, for their part, not much better. In fact, the NASDAQ did end up being the worst performer of the three, at least thus far. As we mentioned, Williams-Sonoma has been one of the biggest winners on Wall Street today. This after it beat earnings estimates and raised its outlook. Coming up, CEO Laura Alber will join us on those results. We'll get her take on the strength of the consumer as people continue to upgrade their home decor. Plus, we have another huge hour of earnings ahead for you. Peloton, HP, Dell, Workday, Gap, all set to release their latest results. We're going to break those numbers down as soon as we get them. Stephanie Link from Hightower is still with us, and Greg Branch from Veritas Financial Group joins the conversation as well. But first, let's get to Mike Santoli for a quick take on what we did see today in the markets. Mike.
Yeah, David, to me it seemed mostly like hesitation ahead of the one thing that all week we've been sort of looking toward for some potential guidance on the policy shifts that might come down the road from the Fed, the Jackson Hole speech tomorrow by Jay Powell. But in general, it's been upward drift into today, and today was really more downward drift. Still not a lot of heavy volumes. It hasn't really necessarily been a lot of urgency behind the action, but a little bit of a test of whether this rebound we saw in recent days of those economically sensitive groups was really something that was a shift in leadership that's to come, or if it was just a bounce. And today we gave back a lot of, maybe a third of the gains for the preceding few days this week in those areas. Treasury yields, rock steady. Not a lot of macro driving things right now. I think it's mostly about, hey, markets come a long way, up 20%. Might be a huge streak of 2% monthly gains that we're still working on. So there's a sense out there that the market's given us a lot already. But until it really breaks down or shows a change of character, I don't really see a lot of active selling coming in to really cash in on it.
Greg, especially around some of these economically sensitive cyclical stocks like energy, which are still leading the week by far. The group is still up more than 4.5%.
Right. Yeah, look, I'm going to disagree a little bit. I do think that we have some macro concerns settling in here. I think that at the end of the day, it is really difficult right now to make a coherent argument that monetary accommodation is still needed to nurse the labor market back to health. We've had 3 weeks of pandemic low job claimless numbers. We have a surplus of jobs, about 1.5 million more jobs available than we have willing workers. And so I think the market is looking for the Fed to explain in any way possible why we still need accommodative monetary policy. And I think that that's where we've been sideways into Jackson Hole, and I think we'll do that again until we hear from Jerome. So I think you'll continue to see what we've seen. We'll see some volatility. We'll see some interest rate sensitive sectors move, and we'll wait for direction and certainty from Jerome tomorrow.
Yeah, well, Greg, we are going to hear from Jerome, as you just said, tomorrow. We did hear, though, from a number of Fed governors today who did indicate, at least in their opinion, the taper needs to begin fairly soon. Is it not soon enough?
I would argue that it's probably not. There's two sides to this coin, right? And I've already described one, which is that we don't actually need monetary policy. The labor market is actually quite healthy. What ails it is that we don't have enough willing workers. But the other side of this coin is that I worry more about Delta's impact on our supplier and trading partner countries. They are much less progressed on the vaccination curve than we are. Taiwan's still somewhere around 4%, for example. And what we're seeing is closures in a lot of those countries where we depend on raw materials and components. This is going to necessarily mean that the inflationary pressures that we're seeing are much more than just transitory. Unless transitory to you means longer than a year. And so I don't look for resolution to a lot of that until mid-next year. The shipping crisis has increased. We're seeing 40-foot cargo container rates 400% what they were a year ago. Going to California, we're seeing 600% to some parts in Europe. And so all of this will continue for the foreseeable future. And so I think the transitory narrative is dead, and the Fed needs to turn its attention to the inflation, and I think that that's what they'll do.
All right, let's get to Peloton results because they're out. And by the way, Diana, I noticed the stock is down sharply, so let's get the numbers themselves.
Yeah, that's because it was a rough Q4 for Peloton, which reported a loss of $1.05 per share versus estimates of a 45-cent loss. Revenues beat at $937 million versus estimates of $927 million. Q4 ending connected fitness subscriptions grew 114% to over 2.33 million, which was above estimates, but paid digital subscriptions were below estimates at 874,000. Gross margins were far short of expectations, 27% versus estimates of 35%, and that's significantly lower when compared to Q3's gross margin of 35%. Margins were hit by the recall, price cuts, as well as supply chain and freight costs. Peloton announced today it's dropping the price of its basic bike model from $1,895 to $14.95. Also, having received approval from the Consumer Product Safety Commission, Peloton said it will begin selling its tread in the U.S. on Monday and resume sales in the U.K. and Canada. Q1 guidance not good. Revenue, connected fitness subscriptions, and gross margins all below estimates. But full year guidance of $5.4 billion is slightly above estimates of $5.27 billion. While that's good, gross margin guidance for the whole year is well below estimates, so that problem is not going away. Back to you guys.
Okay, yeah. Thank you, Diana Olick, with those numbers. Of course, Sarah, we can see the stock is, well, we'll see how it opens tomorrow morning, but down as much as 12% now. Interesting in terms of margins, how they're taking a hit at this point.
Also, this was always a concern with the stock, and that was it was as good as it gets, right? During the global pandemic, it was pulling forward so much demand. And I think the news of the tread coming out a little bit earlier than expected and going a little more global than expected gave the bulls some argument there that they can make up for the bike sales, which have been so strong during COVID-19. But Steph, what do you do with the stock after these numbers? It's down more than 13% after hours.
I mean, I can't justify the valuation even down this much. And remember, you mentioned it. The stock did rally on the tread resumption on Tuesday. It was up 7%. So, and the gross margin numbers are really disappointing because they're lowering prices on the tread and they have higher freight costs. So we talked about before, they don't have pricing power at this point, and it's an ultimate stay-at-home stock. And so there's so many uncertainties ahead of it. Look, it was a great stock last year, and it was a benefit from stay at home. I think it's the narrative starts to change, and I think they have great products. I just don't think the valuation makes any sense at this level.
We're going to talk more Peloton in a moment, though. Let's hit Workday earnings, which are also out. Contessa Brewer has those numbers. Contessa.
We're seeing revenues coming in just a slight beat here at $1.26 billion versus the $1.24 billion according to the estimates. But the earnings here, this is a big beat, $1.24 versus the 78 cents estimated earnings per share that's adjusted. The other thing is this company says, look, this was one of our best quarters in the company's history. They're taking advantage of the digital expansion around the globe and talking about the fact that they now have 55 million subscribers, half of Fortune 500 companies, and now they're raising margin guidance to 21%. You can see the stock jumping there 3 1/3%. I'll keep my eye on it, Sarah.
As will we. Contessa, thank you very much. And don't miss Jim Cramer's exclusive interview with Workday CEO tonight on Mad Money. Just want to come back to Peloton for a moment because we are seeing some pretty steep declines there, Greg. Wondering if you had any thoughts on the numbers, the margin miss, and obviously the much wider than expected loss than what was expected by almost double, more than double.
Yeah, I actually think that the key data point was the decrease in pricing on the bikes. Look, this is positioned as a growth story. They're putting up a triple digit, both subscription and connected fitness. But once you start to reduce pricing on the bikes, now we have doubt as to whether this is a growth story with legs. Anecdotally, it was easy to say that this was the ultimate stay-at-home story, but they were adding content to keep users engaged, and they were entering new markets. And I think all of that gave the bulls hope. But again, that hope starts to crack. The very foundation of that hope starts to crack if you are purchasing the growth by decreasing the pricing on the units. And so I think that that's what the market is primarily worried about in that price drop.
Should mention as well, there is in the release here an internal controls update. Now, it's not material, but they do say in their upcoming annual report, Form 10-K, in the course of their audit for 2021, a material weakness was identified in their internal controls over financial reporting with respect to identification and valuation of inventory. Again, it was a result of discovering an immaterial discrepancy in their year-end physical inventory count. So it didn't result, Sarah, in any material misstatement, but it is something else that can unnerve people on occasion as well.
Down 13.5% or so. Mike, did you want to weigh in on Peloton, just the share price performance and where the street is basically on this stock, where we're kind of in this in-between world of stay-at-home stocks and figuring out what Delta is going to mean for our economy?
Yeah. I mean, it's traded. I mean, look, it was before this after-hours drop. It's down by a third from its highs. It had the big kind of reopening sell-off. It regained part of it. It looks like a whole lot of stuff. It looks like Zoom in the trajectory, the same kind of massive gains, big drop, and then a partial rebound. So I think in both cases, you have a really hard time sleeping with the valuations as they are if you don't have a pretty direct path to multiple years of really strong growth. It's not about like, oh, they have a great brand and people love the product. That doesn't get you quite that far at these valuation levels, even if, we've proven that, maybe competitive threats and things like that might have been overblown in terms of the bear case in the past.
I want to get to HP earnings. That's HP Inc., symbol HPQ, and Josh Lipton has the numbers for us. Josh.
So, David, HP is reporting Q3 results here. EPS of $1. That's versus expectations of 84 cents. Revenue, $15.3 billion. The street was closer to $15.9 billion. For Q4, they're guiding for between 84 and 90 cents. The street was at 81 cents there. For the year, they do raise their target. Now they're looking for between 369 and 375. For segments, personal systems, PCs, $10.4 billion. Analysts are looking for $10.9 billion there. And printing, $4.9 billion versus expectations of $5.1 billion. I did have the chance to speak with CEO Enrique Lores. I asked about that PC market, his outlook there. He sounded a confident tone, saying we see very strong demand for PCs. We see a shift from consumer to commercial as companies now reopen, he said. And we also expect a new version of Windows to drive growth as well. However, he did talk to me, too, about some challenges the company is facing. He said revenue would have grown faster if not for these ongoing supply constraints. We're constrained, he told me, with low-cost components like Wi-Fi connectors and controllers. We are selling everything we can produce, he told me. Working hard to ramp supply to meet demand, but we expect this tightness to continue at least through the end of the year and probably through the beginning of 2022. Back to you all.
All right. Well, selling everything you can produce is usually a high-class problem, Stephanie. But, they had been a beneficiary, of course, of the stay-at-home economy. Unclear how that's going to affect them. Mm-hmm. And then we heard about the chip shortage, which you were describing earlier in terms of at least your desire to potentially own some of the chip makers.
Yeah, by the way, Lam Research just raised their dividend, so that's one I own on the semi side. HP up 19% year to date. It's been a great story, right? 8.4 times forward estimates. You get a 2.7% yield. They have been delivering and executing since he has become CEO. So they've done a very, very good job. I am not surprised in the least in terms of PCs. I mean, that was the concern. That's the reason the stock is off 17% from its highs, right? We knew that we were going to see decelerating PCs because of the shipments and shortages. We knew printers had a challenge because slower back to work, right? So I think if this were to pull back materially, it's certainly worth a look. They've been executing and doing the very best that they can in a very challenging environment. And PCs are not going away, nor are printers.
HP down almost 2% after hours, recovering a little bit. Greg, I'll give you the final word on the conversation because we sort of got your worldview. You think that inflation is going to be a bigger problem. Sounds like then that the Fed has been talking about and that they're going to have to ultimately respond to it. Think that they should be tapering. So what does that mean in terms of what your portfolio looks like and where you want to be right now?
Look, I think we hit on this at the top of the hour or before that when we had the conversation about retail. I'm looking for things that are somewhat immune to the pricing pressures. I'm looking for things that can pass on pricing. So when we talked about those retailers a little bit earlier, I totally agreed. I'm not looking at the Dollar Trees. I'm looking at the Walmarts and the Targets, still in that value segment, but able to pass on pricing and able, if we do retreat to more stay-at-home than we anticipated, are well positioned for that given their investments. And so, right now I'm going to hide out in things that are safe, things where we know what the business model looks like. Lots of things in big tech, some of which we're talking about today, like Workday, are 20+% growth stories, multi-year growth stories that I think are underappreciated right now in their valuation, not necessarily subject to the wage pressures that we're seeing in the mid to low end. And so you want to insulate yourself from all of those acute pressure points and find stories that are insulated and offer you a growth story, a multi-year growth story, multi-year growth catalyst that you can pinpoint and count on. And then it's just all about the company delivering on those opportunities.
We'll leave it there. Stephanie Link, Greg Branch, thank you both for joining us. on a busy market day.
Thank you.
Still ahead on the show, Gap shares are down 20% since the start of May. They had been on a roll, though, into there. Find out whether the retailer can turn it around following the latest earnings report, which will be released in just moments from now. Plus, we will take the pulse of the consumer when we are joined exclusively by Williams-Sonoma CEO Laura Alber in the wake of the company's big earnings beat and big stock rise today. We're back in just 2 minutes on Close.